All right. Hey, good morning, everybody. Thank you for joining live. I'm going to jump right into it, and we've got a lot of stuff to cover. So, as all of you are very well aware, I'm positive there's been lots of volatility in the market, right? And so, I think what it's really important to do whenever there's extreme volatility is we've got to keep ourselves centered and grounded in reality and not let just the intraday price swings and movement sway us too far one way or the other. And so what we need to do is constantly come back to the balance sheet, because this will give us a lot of clarity as to what the market is doing. So for those of you that are new to this, or to me in particular, what we tend to look at are these ending stocks numbers and this ending stocks to use number. And it's in this business is real simple. The higher the number, the lower the price. The lower the number, the higher the price. Right? They have that inverse relationship. And same with this. The higher the percentage, the lower the price, and therefore. So let's take a look at what the market's telling us, what it's doing, and put it in context of weather, to gain some clarity on where the market may be going and why we're positioned the way we are. So this is what I think is the most bearish probability that could be out there. Okay, if you take what the USDA says our acreage is going to be from the March Planting Intentions Report, which is 91.1 million acres, and you yield what they say we're going to yield, which is 179.5, and demand is what they say it's going to be, then our carryout will be 1.3 billion bushels, stocks to use at 9%, which is probably $5, $5.50 corn, somewhere in there. Maybe even a little bit lower, 475, something like that. And now you've got the market that's really jittery, and it keeps trying to price in more acres, because we know that we rallied from 350. Oh my gosh, we doubled the price of corn. We're gonna plant fence post to fence post. We're gonna tear down trees and plant like crazy. So there seems to be this movement, or this line of thinking, that says we're going to increase acreage, which I do here. I have a 3 million acre increase here, and I have a 6 million increase here. When we look at this and we put in a yield of 179.5, which is the highest yield on record by 3 bushel an acre nationwide, when you do that and you leave demand where the USDA says it is, then yes, this would argue for lower prices, because these numbers are going higher, right? Okay, so we seem to have a line of thinking along those lines. But if you're paying attention to what the weather's doing, and you pay attention to what the USDA is saying, and read everything else, you've got to make a couple of other assumptions. The first assumption I think you got to make is demand increase. Look at the trend from the beginning stocks for the last year. Okay, we started with 2.2 billion. We're now down to 1.1. Best guess is that the USDA is somewhere between 250 to 500 million bushels too high on this number right here. And so what I've done is built the model, and I used 350 million bushels, and whether this number comes down or this ending number comes up, it doesn't matter. It's the same effect, okay? When we turn that on, it decreases this carryout. But now what we have going on is a very real probability that we are not going to hit a 179.5. And let's talk about why that might be here for just a minute. So remember these numbers, okay? Because we're going to come right back to them. And I think they're way more important than what the charts are doing at the moment. So keep a look at this, okay? Let's talk about a few things. First is our crop condition ratings. Our crop condition ratings took a massive dive this week, and Iowa, our largest producing state, took a 14% hit in its good to excellent rating, okay? So Jeff has done a nice job of building this model out so that we can get a yield estimate based on good to excellent ratings by state and extrapolate that out, okay? So when you take in the effect of all of the good to excellent ratings and what the USDA is saying at the present instance, we have a yield of about 170.6 coming through, okay? Now, how do we get there and why do we think this is relevant? Well, in order to hit a national yield of 179.5, assuming that we're going to plant between 3 and 6 million extra acres in fringe states, right? We're not talking about adding acreage in the main states where the soils are the best and we plant and we have a solid corn bean rotation. That's not where the acres are going to come from. And I think we all know this. It's going to come from a lot of double crop acres. It's going to come from acres on the fringe that don't have the capacity to yield 250 bushel corn. So when we look at this, we know that this state right here, Iowa, has got to perform and it's got to deliver. It's got to do it in order for us to have a 179.5. And I think that is a critical assumption in my logic to for my analysis to hold. I do not believe that you can have a 179.5 unless these three states right here and Nebraska deliver record yields. I don't think you can do it mathematically. So when you see Iowa decrease its good to excellent in 1 week of by 14 points with a forecast of 100-degree heat again for 10 days beyond the last rating day, with almost zero rain, my logic suggests that those ratings are going to keep coming down. And so this number right here at 170 might be too high. Okay, now I'm going to go to weather, okay? So overnight, we had corn start higher and we had them work a little bit lower overnight. So we went up and then all of a sudden we started backing off. So here's what's going on. I am absolutely not a weatherman in any way, shape, or form, but I'll give you my best understanding, okay? These are the three different models that we have to look at. You've got the GFS model, which is our model. You've got the Canadian model, and you have the European ensemble of models. And what happened overnight is that the European model failed to produce. They had some technical issues that came out. So they didn't deliver their model at the midnight run. And so all the market had to do and the algorithms had to read is this one basically, which has some moisture in the 6 to 10. And we've all been reading about the rain chances and everything else. Well, fast forward to this morning, about 6:20, the European model delivered. And I guess what I'm going to add a little bit more to, this model has not been real accurate. The Euro model in the recent 60 days has been far more accurate than the US model. So here's what the Euro model is now as of 6:15. They have taken virtually all of the precip out of their model, okay? Basically what they're saying is the tropical storm that's brewing in the Gulf is sucking the moisture out, and it's going to create, if we do get rain, it's going to be clustered and it's going to have high winds and it's going to be severe weather, okay? And so this is the most important piece to me right here. The tropical system to the south is robbing our moisture, which is looking to be more and more problematic. And then you look down into the Euro's temperature outlooks, and it is talking about a heat ridge setting up at the end of June into the beginning of July, which we all know what a heat ridge does. It centers high pressure and it prevents moisture from accumulating and from dropping, okay? So the Euro model is now suggesting hot and dry all the way through up to basically pollination. So the weather is turning more and more bullish as we go. So now let's go back and think about what the market's job is and what it's got to do. Because we know that as of last week, our yield estimate is down around 170, well, not 179. And so let's factor that in, right? Well, let's put that into our yield. Remember, 1.7 and 2.2, this is what the bears are arguing. Oh my gosh, we're going to have this massive crop. Well, if you put in a 170, all of a sudden we're not so hot because our stocks to use ratio just went down. If you add the demand in, we're apocalyptically tight. Now, if you have a heat ridge set up over the Midwest and you fail to get the rains that are coming, the corn plant needs about 1.5 inches to 2 inches a week, right? And you got to have 24 inches of water to grow 250 bushel corn in Iowa. So as those chances go down, the odds of these yields getting back up reduce dramatically. So what if we do get that heat ridge, and what if Iowa keeps getting hit? Well, let's look at a 10% yield reduction. This puts corn in a position where we must ration prices. So in a world where you ration, and I want to hit rewind here for a second and go back to 2018 and what we talked about then, when the price of corn started to rally and got to 425, 450. If you remember the setup then, what we had was a market that got wet. We couldn't get planting, and so preventive plant was very, very attractive. So the corn market rallied in order to induce farmers to plant rather than take prevent plant. And we got really bullish in that scenario too. And we made the argument on one of our market chats that that corn demand and food demand is inelastic. You can only change the demand, the usage number so much because we've got to feed too many people and critters. And we also made the argument that energy usage was inelastic and you had to have bushels to grind. And at the time in 2018, the ethanol margin was really, really low and negative. So when corn rallied, we actually destroyed demand in 2018, which put a lid on prices because the ethanol margin failed to expand to make room for higher corn prices. Guys, that is not the case here. Our demand is solid and strong because the margins are there to support it. The ethanol margin is out to $1 a bushel, even at $8 cash corn. So wrap your head around this, okay? We are not rationing demand. If we're going to avoid a setup like this, and we're going to build in any type of weather premium, we must ration demand, which means we must collapse the profit margin on something, whether it's ethanol, feeding, I don't know what it is. You know, we're not gonna out ration China because they're hungry. There is no price that they won't pay for food if they have to have it. So and they can print money. So that's a sovereign government. You're not gonna out ration them. So we must ration somewhere else, which means we have to make something else unprofitable, and we've got to put tremendous premium into it in order to make that happen. And if ethanol is positive at $8 a bushel cash, how high do we have to go to ration to prevent this from happening? Which is why we are extremely bullish corn into this technical setup here that we have as well. So if we look at the technicals in corn, let me pull this out. We drew this box on here last week, and we came into our cloud, okay? As long as we're above this cloud, we're inherently bullish. When prices break down and start breaking below, we start to turn more bearish, okay? And what we thought would happen last week is we thought we'd get a retracement of some kind, and we sure have. It's fallen right down into the sweet spot, and now we seem to be finding some support. and we're starting to see the forecasts start to turn more bullish. So I think the stage is set for another leg higher. We could have another little up-down sequence if these, as we kind of bide time and wait for these forecasts and everything else. But I think the risk to the downside is dwindling because the fundamentals, the drivers, the things that matter, are continuing to lean to the bullish side. And so if somebody can make an argument to me that we're going to hit a 179.5 and we're going to plant 6 million acres, then we're going to sell corn because we're way overvalued at that price. But the metrics we look at are just simply not there to warrant a big hedge. So I know this isn't very fun, right? When we we went home Friday thinking, hey, we're coming up and away because the forecasts are so bullish. And then Sunday night they shifted, and the U.S. model turned wet and cold, and so we just pummeled it Monday and Tuesday. Well, now here we are, and we're already taking the moisture back out. I don't know why that is. I don't know why the models are different. There's a lot people that are a lot more educated and smarter than I am about that stuff. But I just know that we keep trending drier and we keep trending hotter. And when guys that have done this for a really long time are saying things like, if your corn curls for 4 straight days, you have a 10% yield loss, and you're seeing pictures of corn curling all over the country, it makes me think that we may not hit that all-time record yield because we're just simply not getting the water to it. So the downside appears to be shrinking. This looks like a fantastic buy setup right here, where you can buy it and put a stop right here at 560. And if something changes, then we may change our mind too. Now, soybeans. I think what's going on with soybeans is we've got bean oil that broke, we've got meal that continues to trade poorly, and we got bad crush numbers last week or yesterday. And in China, there seems to be a backlog at the ports. Whether that's COVID related or there's just too much stuff going on, I don't know. But we seem to be in this kind of pattern where there's just not a lot happening, not a lot moving, not a lot of stuff going on. But that's not bearish beans. Actually, if you look at it, we have the same setup that we had in corn. And if you look at the soybean balance sheet, I didn't even talk about it because it's so insanely bullish. Like it's almost impossible to wrap your head around that. This is the yield the USDA is using, and this is a 10% reduction in yield off of that, and we are negative on soybeans. So we've got to ration those as well. I don't think we're rationing bean demand yet. I think that the crush numbers were expected to be lower because and as those crush numbers come down and we slow down the grind, what happens is we feed more meal and we dwindle those supplies, which means we need to crush more beans in order to replenish those supplies there. So I think that the bean demand is really good. I think that China is going to keep taking them and keep buying them. Yes, I think that the South America grower is going to plant a lot of beans, but I think the volatility is here to stay, and I think that we've got to go higher in order to ration before anything else can really happen. So that is our analysis for the week. Stay centered. My recommendation is don't stare at the screens. It's going to be wild. It's going to be crazy. But until we get something that moves the needle away from this analysis, I think we've got to lean to the bullish side and keep our upside wide open and not get overhedged too soon, too early. Because I know 550 corn is really good, and I know that nobody wants to see it go away, but 550 corn isn't going to look very good if we're at 9. And I think that's the setup that you're potentially sitting on here if you really lay down. So having said all of that, there is tremendous risk in this business, and trading futures and options is risky for everybody. So before you do it, please make sure that you're trading in light of your financial condition and are managing your position sizes accordingly. Stay tuned to us. We will keep you updated, I promise, when things materialize, and we will talk to you next week.